attendees are in listen-only mode.
Good afternoon, everybody. Stan and Jack here for theartofchart.net, and we're doing a webinar on trading using pattern analysis. And so pattern analysis, we're going to be talking about triangles, we're going to be talking about channels, we're going to be talking about megaphones, we're going to be talking about wedges, and anything else that you have an interest in. Okay, so this is going to be sort of introducing the whole idea of pattern analysis, how to trade those patterns, so on and so forth. So there's a questions tab, so if there is something about patterns that you have questions about, or along the way if you have a question, please post it and we will get to it. Okay, so with that said, let me go over our disclaimer quickly. Disclaimer. And also I want to just talk just a minute about what's new on theartofchart.net. Our disclaimer, we do these webinars for educational purposes only. We are not issuing trading signals, and so we have this website here to support traders in learning about trading, whether it be trading psychology, trade execution and management, or whether it be charting and technical analysis. We do all three here. So that's the purpose of theartofchart.net, and what we do is education, and we don't do signals. In terms of what's new here, I just want to make sure everybody's aware that we have a new service called the Trader Triple Play. I'm sorry, the Trader Triple Play is our existing service. The Big Five, sorry about that. The Big Five is a charting service for the Big Five stocks. Amazon, Netflix, Facebook, Tesla, and Apple. Okay, and we're doing very well with it right now. And so there's a 14-day free trial on the front page if you're interested. Please sign up. On our blog, and this is something I should also mention, everybody should be aware that on our blog we always have a free webinar page for the month. And so this webinar will be posted on this page when we're done, okay? And as you can see on this page already, we have the free chart chat we do at the beginning of the month. We have our subscriber type videos, but also we have trading using pattern analysis. And when we're done tonight, the video will be posted here, okay? So with that said, Jack, anything else introductory-wise you want to say?
Nope, let's go.
Okay, let's talk about triangles. We're going to start with triangles. Here are triangles. Triangles are basically, for the most part, a continuation pattern. Okay, it's a signal. It's basically a pattern that says there's going to be continuation in the direction of the trend. And what a triangle really means is that, we have indecision. Okay, indecision is happening in the market, and you wind up in a range trade for a while. Now, there are different ways to recognize a pattern and or this pattern, and there are different types of triangles. This type of triangle, ascending, typically breaks to the upside. These are all 70% chances, and this one, for example, the descending typically breaks to the downside. This is the one you got to be cautious with, the contracting triangle or symmetrical triangle. Typically, these can go 50-50, but this is, again, typically a continuation move in the direction of the trend. This is an expanding triangle, okay? You see these on occasion as well. And there are other types of triangles that I'll talk about that are not on this page. And let me get to the charts so I can do a brief job of this. This is a nice chart right here for triangles. Why is that? We have one here, okay? This was back in September, and we have another one here that just finished. Now, what do you get when you get a triangle? Well, you get a thrust out of a triangle, okay? And so here we had a turn, a W, and all this is indecision, and you get the thrust out of the triangle. It's a continuation move, okay? Here we have another indecision, okay? And this was a compression move. And by the way you recognize a triangle is you look at RSI. RSI, if it compresses, you have a triangle, okay? If it doesn't compress, you usually do not have a triangle. So RSI is a dead giveaway for triangles. You can draw the RSI one here differently than I have it here, but basically when you get compression, you have a triangle. And one of the best triangles to talk about, really, in my opinion, is this one here on the daily basis, okay? Daily basis triangle. I want you to look at the compression here. What a classic triangle, okay? This is a triangle called an ending diagonal, okay? So typically at the beginning of a move, sometimes you have an expanding triangle. That's actually, it looks like a megaphone, okay? Off of a bottom, for example. You typically have a triangle off of a bottom, okay, called, and that's called a megaphone also, but basically you get the opposite of this. You get an expansion of RSI, but typically a triangle near a top like this one. This is called an ending diagonal, okay? So you have a big A, 50% back for the B, a C, a backtest for the D shorter than B, and then a short E shorter than C. Now this goes against any and all wave theory, because wave theory typically your third wave is the largest wave, but this is an ending pattern. Okay, this is an ending triangle. It's an ascending triangle, basically. Okay, so I wanted to point out the different types of triangles, Jack, just so people can have a sense of them. In terms of looking at triangles here, typically what you see in a triangle is you see some sort of compression move like this. So you can see this as an A. This would be the A. This would be the B. 3 waves up for a C. 3 waves down for a D, and an E, and you're done. Okay, and you get the thrust. Now, usually what happens in a triangle, and this is the important thing I want to talk about, and this is not something that you'll read in a textbook anywhere. Okay, I'm zooming in here on the S&P 500. Okay, so here we have on a 15-minute basis a triangle setup. Okay, so I marked this W, and we were looking for a B wave type triangle. Okay, so 3 waves up for the A, 3 waves down for the B, 3 waves up for the C. We were looking for a D and E back test, and then a move. Okay, typically what you see in a triangle is this: you see resistance at the upper trend line, of course, support at the lower trend line. When you break the trend line, you get a back test almost immediately. Then you go further, and then you get a bigger back test either into the triangle, like up here around the weekly pivot at 54s, or right to the trend line. And then you get a thrust, okay? So this is very classic. You see a triangle, this is how it's going to play. So if you're in a triangle and you're trying to trade this, the thing I want to mention is this: you do not have to pick a side, okay, in a triangle. You trade the range. You trade the range, and if you got short up here, and we did call this, by the way, at 63s resistance, and then that evening, Monday evening, we said, this is a good short with a stop above. You trade the range, and eventually the range opens up. It eventually opens up. So
I've got a really good example of one of these actually to show. Throw me over the screen for a bit. Yep,
will do.
This is one we prepared earlier. This has basically been playing out for the last month and a half. So if you throw me the screen down, brilliant, thanks.
The thing I want to say about triangles is this: if you're trading triangles, okay, and you're trading the range, you have a second bite at the apple, because the back test back into the triangle is where you can get into the move. Okay, so if you're insecure about which way the triangle is going to break, you as a trader can do nothing, and you can just wait for the back test. Now, the back test doesn't happen in every single triangle, but I think the back test happens at least 70% of the time.
Yep. And actually, this is a good illustration of the level of predictability that you can get, because I was drawing, I drew this chart, and obviously this is updated to today's prices, but I drew this chart on the 28th of August, and I wrote these notes then. And what I was talking about then was we had this lovely triangle here, and that was A, B, C, D, E. E's shorter, doesn't reach triangle support, that happens a lot, and then it broke up. And then, at that point, I drew these arrows. Now, the arrows weren't taking into account of time and cycles and so on and so forth. They were about price. And so what I was talking about was a back test into the triangle. Went a little deep for that, but yeah, respected triangle support. So that was the back test. Then I was drawing a line to what I felt was the very obvious target at 17.5 because that was ABC on that, and also it was a potential IHS neckline. And then I was looking at a full retracement of the triangle thrust. Didn't quite make my arrows there, but it got into the right area, so that was enough of a retracement to be a full retracement. And then I was talking about it going up again, because I'd moved on from the triangle by that stage, because the triangle just gets you to here. But what I was saying was, we've got most of an IHS at that stage. I'd be expecting it to go up and complete the IHS, and then probably break up and continue up. So actually it's broken up, or we're back testing at the moment, probably going to go deeper, and most likely this is going to play out to the upside. But actually you can see, I didn't get, the timings I wasn't really paying much attention to, but actually all of this you could work out and predict, and actually in price terms that was very close prediction, and that all played out over the next 5 weeks. That is something you can do with triangles.
Mm-hmm. Absolutely.
They have a high level of predictability on what they're going to do. It doesn't tell you how far the triangle thrust goes. I was taking that from obviously other things that I was looking at here. But I mean, back test, thrust, retracement of the thrust. All of these are high probability on a triangle. All right, I'll throw it back to you, mate.
Yep. The only other thing I wanted to say about a triangle, Jack, I think I'm done with triangles. We can go on to channels and wedges and so on and so forth. But I think the thing about a triangle thrust, the one thing I want to say is that you cannot predict the length. Okay, go to natural gas, look at the low in natural gas, look at the thrust out of a triangle. Matter of fact, I'll tell you what I'll do. Just real quick, Jack, I'll show natural gas. 30 seconds, 30 seconds, and that's it. And then get up your channel and wedges and whatnot. We'll do those next. But just to do natural gas real quick, and let's see if I have a chart here that I can show. And I may not have a chart handy, but I should have a chart handy. Okay, so here is the triangle on natural gas. Okay, the A, B, C, D, E, we called this, and it was a beautiful thrust. Okay, now look at the size of that triangle. Is there any way you're going to predict that length of thrust from that type of triangle? No way. You just can't possibly predict that. Okay, so a triangle thrust is actually unpredictable. We did say $2 to $2.10. We didn't. We got pretty close. We got right around $2 to 2032. So this was something that we called, and that was based on the structure. Okay, in terms of looking at the larger structure, but looking at just the triangle itself, you can't predict the thrust. It's not predictable.
Yeah. You can, using other things, like I was doing on that 10x one, like Stan was doing with this NG one, using other methods, you can actually come up with targets and often reach them. But they are different methods. You're not calculating, looking at the triangle and thinking, oh well, it's going to go out this amount, because actually it isn't. The variation's very wide. So here, that was successfully called on the target there, but it's still not something you can always do. And you are using other methods to do it. Right. Okay. Now I want to talk about trending channels. And let's have a look. Just use an example from. Okay. Well, actually, I'll just look at this example to start off with. This is a favorite chart of mine, and this is actually the bull market from 1982 to 1987, culminating in the 87 crash, which is here. Now, what I just want to say is, all of these, a channel, a wedge, channel here, wedge here, megaphone here, all of these are trending patterns, i.e. they're directional. And all of them, in my view, are actually just variants on a channel. You've effectively got a parallel channel, a contracting channel, and an expanding channel. And that is all these are. They're all. You often hear that megaphones and wedges are directional because these a rising wedge is 70% bearish. This is a good example of one that broke up. And you've got megaphones that are at 70% bearish as well, and channels are supposed to be direction neutral. Actually, this is all just a nonsense, because if you think about it, at the end of the day, if you've got a trending pattern, because of the nature of reversions of the means, retracements, etc., if you've got something that's strongly trending up, obviously it's the odds are going to favour a breakdown from it. That's just basic maths. It's not really a matter of the pattern is telling you that it's 70% that likely it's going to break down. It's just 70% likely to break down because it's going up. And it really is. It's just as simple as that. So a lot of this sort of adds mystery to patterns where there isn't really any. All these is trend lines being established during a trending move. I'd say that really you don't see a lot of overthrows from channels, but you do from megaphones and you do from wedges. But apart from that, they're really pretty much the same. It's just a matter of which way that the trend lines are pointing. This is a very good example of a counter-trend break. Now, I've got another one to show here as well, and this is, I've got two very classic examples, and these tend to, when these happen on SPX, certainly on the larger scale, these tend to be very, very classic in the way they happen. And this is, you get the break up, and at this stage, you're looking for an overthrow, because your lean is downwards. So at this stage, people are thinking, well, this is an overthrow, and it's probably going to break back in. It never breaks back into the wedge. It comes back, it backtests, wedge resistance, and it breaks up. And this is an absolutely classic example. one that broke up, and it went up, made the target, formed another pattern, and then did a very fast Fibonacci retracement of both of these patterns together because those comprise the bull market. I've got another example, and again, it's a beauty. This is
on that example, Jack, it actually backtested triangle. I'm sorry, the wedge resistance trend line. The blue wedge, yeah. You draw that.
Yeah,
you draw.
That's my point exactly. You're looking for a bearish overthrow here. It never broke back in. And actually, on both the examples I'm showing here, they didn't break back in. So really, you're leaning bearish here until you see an impulse up off this retest. At that stage, you're leaning bullish. And now, I wasn't actually charting at the time of this one, but I was charting at the time of this one.
But now the point I was making there, October of '87, is when you backtested that. What often happens in a wedge is you come back and you backtest back after the bullish move. You come all like right there, $216 right there.
Yep.
If you extended that blue line to the right, you're backtesting the resistance trend line. I'm sorry, the resistance trend line. That's correct. Yeah, that blue line. If you extended it, that happens so often out of a wedge. You break out of the wedge, you do this big bullish move, but then the retracement comes back to a fib number like you have there, the 50 back, but it comes back very often, so often to the actual trend line.
Now, this brings us to Fibonacci's. The Fibonacci's are very, very closely associated with these patterns, and that's because you are really looking at, and this is a beautiful Fibonacci retracement, and that's what you'd have expected, because these patterns with Fibonacci's give you an awful lot of information. What you're looking for on a break from these patterns is a target. I mean, really, when you're talking about this move up, this is a 100% Fibonacci target. You're looking at a 50% Fibonacci retracement, which is the most common kind. From the overall bull market from here. When you are looking at a trending pattern, you're looking at really two types. You've got an ending pattern. You quite often see these rising wedges. Annotations call them ending diagonals, and these will, if it's an ending pattern, it will retrace entirely. Yeah, but otherwise they are continuation patterns. And how do they continue? They break down, they do a Fibonacci retracement, or something reasonably close, and then they continue upwards. So you are looking for that Fibonacci target. And actually, I've got a good example of that. Hang on one second. Right, I was showing one today on the SPX daily chart, and I was saying this rising wedge, which is from the February low, that's just broken down today. We went and backtested wedge resistance. That's held so far. It's probably going to continue holding, I think, but you know, we'll see. I've got a couple of indications that we might go higher, but actually, really, I think that probably is going to hold. But what I was saying was the double top here, which isn't a great quality double top, but I've got much better ones on NQ and TF. It's but if you look at the double top here, the target here at 2045 is a very good match with 38.2% fib retracement at 2047. Now, on a pattern like this, which is going to continue up, and we are expecting this one to continue up into at least really a retest that's high, or at least I think that's a reasonable expectation at this stage. Then you're looking at a Fibonacci retracement. The usual Fibonacci retracements you would be looking at would be the 38.2, the 50, or the 61.8. And chances are you are going to get a move down to close to one of these levels, and then rally back up. Quite often a double bottom, because from there, because double bottoms outnumber head and shoulder patterns by about 2 to 1. Now, I was posting this morning, and I was saying that this is the very obvious target for this move. I don't think it won't make it all at once, and it may be that we've got more work to do. We'll retest this high, because as I said, this isn't a great double top. It's before that happens, we may still be in a topping pattern. We may not reach this target, but this pattern here is supporting the move to here, and this is a very, very obvious level to reach when you're breaking down from a rising wedge. And at that stage, once you've reached a Fibonacci target and made a new high, you're basically disregarding this, although it may be part of a new pattern, a larger degree pattern. But you reach one of these targets, and then you continue up, and that's how these work. And it's the same for channels, and that's the same for megaphones. You're always looking at those Fibonacci targets. You always have to watch the 23%. That's quite a lot. That's somewhere you quite often see a bounce if you're actually forming a large pattern. Anyway, the other example I wanted to show, this one is actually from the low in 2009. We had a rising wedge. It breaks down. It retraces 38.2. And then you form another rising wedge. Now that one breaks down here, and that was looking pretty bearish, and then it breaks back up, and then it breaks back, breaks over wedge support. Now at this stage, you're wondering, this could be a bullish underthrow. Yeah. So what happens then? You get a break up, you get a retest, it holds. You break up again, you get a retest, it holds again. And at this stage, I did a post calling a target at, where was it? 1965. These are very, very good at making targets, in my experience. Polkowski doesn't rate them as highly on a counter break, but actually, in my experience, these generally make targets. So, you know, move on a year and a half or something, and we make that target. And that was very predictable at that stage at 1560. That was a strong target at that point because of the structure of this wedge. Because you've got the bullish underthrow, you've got the overthrow, you've got the perfect backtest, two of them actually, and then it goes. And that was a very, very useful trading pattern. And I called that out and was using that for the next year and a half, and it made it. So, and that's what you would expect to happen. All right, great. Just going to show a couple of other examples, if that's okay.
Yep, go ahead. I have a wedge whenever you're ready.
Okay. Well, I just want to talk about predictability here. Yeah. This is an overall rising wedge on the yen, and this rising wedge within it. I'd been watching for a couple of years because I knew sooner or later there would probably be a very nice short setup. And I was watching it on this chart here, and I called it here because what you're looking for on a break of a wedge or a channel or a megaphone, really you should be seeing them as pretty much the same sort of pattern, just with trend lines pointing in different directions. What you're looking for on the break is you're looking for the reversal pattern. And here, of course, it was already pre-baked. You've got the left shoulder, you've got the head, got the right shoulder, and by the time we got to the second break here, the head and shoulders hadn't broken down, but it was pretty obvious what was happening. You had the first breakdown from the wedge, back up, complete the pattern, and and you're off to the races. So this was a beauty. I called it and did a post on it there, and obviously it declined a lot. Now this was an ending diagonal, and this was a full retracement. But if you look at, I was calling this in August last year, and again, this is a level of the predictability of these patterns and the way they act. And this was, I think it was in August last year, and it's before this had actually broken up. But obviously you've formed a falling wedge, it's nice quality. The yen does tend to produce very nice quality patterns. And what are you expecting here? Well, you've made the full wedge target. Full retracement was at 80.55, and that got down to 79.66, and done a couple of months earlier. We were working around here. I could see an IHS neckline here. So before this broke up, I suggested that it was likely to break up. I could see a partially formed inverted head and shoulders that I thought might well continue form and then break up. And then I was talking about a return to the 38.2% fib retracement. And I was showing that on this monthly chart because there are two targets here that I was talking about. I was talking about the bigger picture falling wedge, which is broken down. What do you often get after a breakdown? You get a backtest. And really, this falling wedge broke down through it, and this was a rally to deliver that backtest. So I was talking about two targets, which were the retest of this broken support trend line, and most likely a slight poke up through it to the 38.2% fib retracement. And that's exactly what we've seen. And this was a very, very useful and predictable trading pattern. Yen delivers those. Not every trading instrument does deliver those, but a lot of them do. And there's a lot of predictability in these patterns if you know what to look for. All right, great. I'll throw it back to you, Steve.
Okay. I have a wedge. Just to talk through a wedge real quick. And I want to just look at the Dow. The Dow is always good for patterns, and so this is a wedge that we're currently finishing right now in the Dow. Okay, so we have the three-wave move up for the A wave. We have a three-wave move down for the B wave. We have a three-wave move up for the C wave, which, by the way, did not have a lot of participation. We have a three-wave move down for the D wave, and then hopefully we'll have one last leg higher. And how are we able to predict this? Well, if this is a wedge, every leg of the wedge is shorter than the previous leg. So here we have a long A wave 50% back using Fibonacci's again with the B wave, shorter C wave than the A wave. That's a dead giveaway right there, this impulse that you're now in a wedge. Okay, why? Because this is not longer than A, it's shorter than A. Okay, so shorter than A, we might be in a wedge. Great. Looking for a shorter than B back test. So what do? You take out whatever tool you have, you measure it, and what is that? 110,163 ticks. And what do? You measure what that might be from your C wave right here. And so what does that measure to? Well, it already measures to my number right there, which is 17,528. Okay, so what I know is I know that if I'm in a wedge, I'm not going to go lower than that number. Now, I could get surprised. I could be wrong. Okay, so 30% of the time, I'm wrong on where we are with this market and whatever. So if I'm going to be surprised, I'll get surprised, and I'll probably get long here, and then if we break below 17,528, I have an invalidation level, okay? But bottom line is this appears to me that we're in a 3 down into this area. And the other thing that helps with pattern recognition is using timing cycles. So we use timing cycles on the Art of Chart. Here's a high window, here's a low window. The low window starts next week, it ends on the 25th. So this gives us some support in terms of looking not for where the price lands, but where in what time window price lands. So, are we going to stop right here at this line? I have no idea, because this line is just a made-up fictional line I'm doing right now based on the 618 being here and the 50 back being right here. So again, using fibs, 50% to the 0.618 in the low window. That's kind of where we're expecting price to go. And then if this is a wedge, I don't think it stops here. I think we have one more leg higher. Okay, so, and again, this leg here, if you measured it, has to be shorter than this leg here. Okay, so it's just a function of doing some math. You can see that the 19,260 is an important level. So, with wedges, I guess the point I'm trying to make is with patterns, you can measure, you can predict levels, okay? And it takes time and practice, but it's very useful if you know, hey, there might be support here, let me watch, let me see if it develops. Oh, look right here at this Fibonacci, support has developed, great. There's a short-term long in this for me, So, trading is about trying to find support and resistance, and then, of course, managing your trades appropriately, okay? You got to be able to do both well, of course, to make money. So that's what I wanted to say about wedges and actually, measuring a wedge or measuring a pattern, Jack. I think it's important to do that.
If you throw me the screen back, I've just got a couple of examples I was using today. I'd quite like to look at.
Okay, sure. I have a couple of questions too, and one of these is definitely a Jack question.
Okay.
And so this doesn't have anything to do with the patterns that we're talking about, but you may want to cover what we're currently talking about, but there's something here on a head and shoulders and a double top and bottom. How do you measure a price target for that?
Oh, that's very, very easy.
Yeah,
right.
It is.
Yeah, I mean, here you can see, and actually, if you go and look at the many thousands of charts on my blog, then you will actually see these annotations over them a lot. What these annotations mean, when you've got these, this here is either a neckline or a double top or bottom support to a straight resistance level, yeah? You'll see arrows going up and you'll see arrows going down, and this is how you measure them. This is what I would describe as an asymmetric double top, i.e. you've got highs which aren't that close together. They're close enough together to be an okay pattern, but they're not close enough together to treat it as one level. You could, if you see the simplified version, you're just using the distance from the support level to the top. Very easy on a double top, of course, or a double bottom, because you only have flat lines. You can have sloping necklines on head and shoulder patterns, but you never see those on double tops or double bottoms, of course. Now here you've got the move from support level to here. The support level is actually at the bottom of the move below. So that here is 21.19.12. You're going to arrow up. You'll narrow down, or you can just do it mathematically and take that level there, 219,381, subtract that, and that gives you the number, which you then subtract from 2,119,12 to get your number below. That one's at that's at 2045, and this one here, because I've done 2 arrows here because these are of different heights. You can sometimes find it comes down to the first target and reverses there, and that's why I put in the second arrow. On a head and shoulder IHS, let's have a quick look. I'll just seeing if I can locate one. Oh, okay. Well, I've got one here. This is the bonds chart I did. This is an IHS. It's got a flat neckline. So you've got the left shoulder, you've got the head, you've got the right shoulder. How do you measure measure it on here? I haven't actually marked it on here because I've marked it on the higher degree one. But what you take is the neckline. You take it, if it is a sloping neckline, you take it as close to the time period at which the head was, the bottom or the top of the head was made. And you take an arrow straight down from here, and that gives you your distance. Yeah, and then I just do a parallel arrow, and again you'll see this on many of my charts. A parallel arrow, and you take that from the level of the break. Now that's always at the on this one it's just at the same level obviously because the neckline is a flat one. If you've got a sloping neckline, then I would position the bottom of that arrow at the exact point of the initial break over the neckline, and I would take the target from there, and that's how you measure them.
Yep, makes sense.
All right. Okay, and what was the other question, Bob?
The other question was a question for me about the chart I just showed, but we can get to it later if you want to show the other drawings you have.
Let's try and show a couple I was using today, just to illustrate how you use these patterns on a daily basis. Now, here we've got the breakout of the triangle. We've got the backtest. Probably, if this extends higher tomorrow, then this actually may be the backtest, and the triangle thrust starts from there. Or at least that was my interpretation. Stan's the expert on triangles rather than me, but I use them reasonably well. Now here you've got a declining resistance trend line. This is actually a wedge, and you've got a break up here. And at this stage I'm bearish because it's come up, tested this trend line, and it hasn't broken yet. When it breaks above, I am wondering about a break up, and I am looking for a backtest, and we've seen that backtest. And at this stage, you get a choice. Basically, you can either continue upwards, or you can break down. Now, this I'm considering the possibility. This is actually a bearish overthrow. So we'll see what happens tomorrow. But if you look at the shorter-term chart, this is the pattern that formed on the 1-minute chart from the low today. Now, we've got here, I've drawn in a possible, I drew that in dotted because that is a possible trend line rather than an actual one. The pattern we had today was a rising wedge. It's friendlier when it actually comes and hits the trend line because that's an actual short area, obviously. But what are you looking at here? You're looking at a potential double top. It's breaking down. When it breaks this wedge support trend line, then at that point, you are looking at a nice sequence coming. You will normally get a Fibonacci retracement to 38, 50, or the 61.8, or if it goes beyond the 61.8, you do a full retracement, and you generally would at that stage continue down. What you're looking for here is 38.2. That's at 2129. It gets as low as 2130. Might be close enough, but I suspect this is going lower tomorrow. But after the break, you're looking for don't always get it, but most of the time you will get a backtest. We had a rally here that actually knocked a lot of the shorts out, and that is what you would normally expect on a wedge. You break down, you backtest, and then you continue. So if you don't already have a reversal pattern, but of course here you did. Here you've got a head and shoulder pattern. You've got left shoulder. I hadn't marked it up here, but I was just judging it by eye. So I was thinking, forming the right shoulder here as part of the backtest, you see that a lot, and then you break down, hasn't quite made the target, will probably make that target tomorrow. And that is the pattern. So I was calling the highs here, and we had sell signals there too, which is unrelated, but a different system which we use together with it. And then get the nice decline at the end. So on a day like this, which was a trend day, of course, if you are going to see, well, I mean, it was a cycle trend day. What I was explaining, that is a day when one side or the other dominates the tape to the extent that there is very little in the way of counter trend moves. If you are going to see counter trend moves and a move like that, you obviously have the beginning, because you will often get an AM low to kick off a move up or an AM high to kick off a move down. But the only time you're really looking for a potential break in that trend is in the last hour. And of course this was happening in the last hour, so it was the natural time to have it as well. All right, I'm just going to show, got some time, I just wanted to show a couple of the other charts. I've got a couple of very nice examples today of where these can be very useful for trading. One of them is on CL. And that's going to be...
We got a couple of other questions here too, Jack. I want to make sure we get to them, so we probably have about 5 more minutes.
All right, I'll be brief. Now, CL, this is a very good example of a very practical pattern. Now, this is a falling megaphone which has formed from this high here. This is, we come down here, we've got news here, and the news is bad for oil, you get a spike down. What does it do? It doesn't break this megaphone. I was talking about this megaphone this morning, it defined the day today. We went here, we go up, we do this spike which actually touches, pretty much does support and resistance on it, and we're breaking up there slightly at the end. What does this tell you from a trading point of view? Well, it is shallow, and you get it on a break from a rising wedge. You are talking about, have you got down to the 38.2? You have not. What you're looking at here really is a bull flag. A bull flag which is likely to break up, still 7% likely to break up, and retest this high in what may well be the second high of a double top. Sometimes it would continue up, but more commonly you would find that this would break up, retest this high, make a marginal new high, and then fail. And then, at that stage, you have your topping pattern. I was thinking the topping pattern might be a head and shoulders. This neckline never reached it. It could still potentially be that, but I think the break of this megaphone is most likely telling us that this high is going to be retested. And actually, that high retest, if it is tomorrow or the next trading day, would actually possibly be combined with a retest of this broken wedge support. That's a very nice example, and I was using that today, and I've got another one on NQ, and I'll limit it to that. NQ, right, okay, you've got the triangle here, you've got the breakdown, backtest, and you form a falling wedge here. This falling wedge broke up, and that was an alarm signal for there was likely to be more upside today. And what does it do? The high here is at the 38.2, which is the first area you'd really be looking for serious resistance. It was pretty much a perfect touch and a fail there. And at that stage, this would be this, although it's taken a long time and that may not seem a long way, but that actually plays out this falling wedge. The falling wedge underthrows bullishly, breaks up, makes the obvious target, and reverses that. Lovely classic little sequence, which we saw today on NQ. Okay, great. I'll throw you back the screen.
Okay. I'm going to answer Shelley's question. We're going to do questions now, Jack, just because of time. And I'm going to answer Shelley's question, and then we have other questions right behind that one. How did you draw the line at the bottom of the channel on the Dow chart? Okay. This line, Shelley, good eyes, because this is not connected to anything, right? So how do I know that it's going to go there? And there are 2 things that I do, and I'm going to show you both in a second here. But the typical way you would draw it, of course, is like this, right? You draw it like that, and of course you bump into the triangle and you say, oh my God, we've just broken a wedge. But I don't think we have, not this wedge anyway. I think the wedge is actually a bigger wedge. Now, the way I determine that is twofold. Number one, in a wedge, and this is something you can do, use the box method. Okay, I pay a lot of attention to time. So that is the amount of time that the B wave took. How much time should this downtrend take? Well, right there. Do you see right there the center of that box? By the way, I didn't draw this box based on this method. I drew this box based on her cycles, but look at where it's coming in. It's coming in on the 19th, okay? So pretty high correlation there between 2 timing methods to come up with the 19th. So this is one reason why I drew the box there, is it ends right at that point, number one. Number two, the other reason why I drew the box there is because of this Fibonacci. Okay, so the 618, I'm not expecting it to go further than that, but if this is a rising wedge, timing and Fibonacci's will get you to draw a box in the right place without any support trend lines. The other thing that I do, and I look at this as well, if you're familiar with this tool, the A to C line, duplicate it, and create an Elliott channel. Look at where the Elliott channel comes in, right in the same area. So, you know, what I try to do is overlap multiple methods whenever I draw anything on a chart, because it helps you see things. Okay, I think that the purpose of charting, the purpose of technical analysis is to help you see things. Okay, and that way you can make determinations and probabilities, and hopefully take trades that are only, you know, 70% probable. So that's what I try to do. Okay, Jack. This is a comment from Tom. Kindly comment about VWAP and its significance on the S&P chart. How important is it versus a moving average? And what do you think about it from a trading perspective?
I think VWAP. Moving averages are important on every time frame, top to bottom, 1 minute charts to the monthly chart. And you treat them pretty much the same. VWAP really I just use as an intraday tool. And it is a significant moving average equivalent. So I'd use it the same way I would be using the middle Bollinger Band, for instance. It is a natural support and resistance level intraday.
Yep, absolutely agree with that. VWAP, you can get fancy. You can do quarterly VWAP. You can do weekly VWAP. You can do an annual VWAP. But what's really important with VWAP, especially the larger ones, are the second standard deviation bands around VWAP, the average itself. Even on a day trading perspective, you know, you hit the upper band on VWAP, and guess what? You find resistance a lot. So I think, again, I just want to emphasize what Jack said, which is on an intraday basis, I think VWAP is extremely important. The number of times I've seen it tested and then find resistance, and then we have a trend down day. It's a very valuable tool intraday.
And actually, I've got a very good example today of a third standard deviation, which is a very good illustration example. If you throw me back to the screen, I'll show it.
Okay.
Right. This is actually right today. What happened today? Well, we went down here and we tested the double top support, and we reversed back up. Where did we reverse back up? Well, we reversed at the 3SD daily Bollinger Band. Which I've got marked here. I've got that. Yep.
That's 3SD on a daily chart.
Yes, on a daily chart. That was a 21. That was a 21.15, and the low was just slightly below it. That is a natural level of support. So normally we're looking at the 2SD Bollinger Bands, and those are the first level of support. The second level of support is the 3SD ones. Yep. And that's where it reversed today.
Yep.
It's and I think that's the main reason we didn't go down further today. It was just too stretched, and you will often see a reversal when you reach it. Okay. I just wanted to show that as an example of the 3SD one, because you have such a good example.
All right. Stan, which Hurst cycles do you use for high window, low window, etc.? Sebastian, if you're using Hurst cycles, it's going to be different on a per instrument basis. So you're going to have to track each instrument, but I would say 40 is a good rule of thumb. Okay. However, I use various, I look for overlaps in cycles versus other techniques like the box method, for example. And that helps me pick the right cycles because, frankly, the Hurst cycle stuff, you know, it has some serious flaws in it. And so, you know, very often you miss a window. And so having other tools helps with that. So I would just encourage you to correlate whatever you see on Hurst. I think that's useful. Any other questions? Anyone?
I think actually the essence of what we do at the Art of Chart actually is correlating different systems.
That's right.
To get the trades out.
That's it. I mean, I don't want to trade anything that is less than a 70% probable trade. Otherwise, I'm watching. I think that's kind of the whole thing about trading is be picky. Anyway, Jack, I see no more questions, so I think that's a wrap.
I think it is.
All right. Pleasure as always, Jack.
Pleasure as always.
Yep. Same here. Take care. All right. Bye-bye.